Good morning, everyone. Welcome to this update for the 23rd of July. There are many positives out there. I know that a lot of traders and investors are still looking for a reason for this market to roll over because that's how human nature operates. We're always looking for something that can go wrong. But we've just got to acknowledge the number of positives that are out there, both in terms of the economic fundamentals, the corporate fundamentals, and also just the price trends, because at the end of the day, it's the price trends that are really the most important. So let's jump in and have a look at what I'm going to cover in this update. I'm going to have a harder look at the US indices and just highlight how strong these trends are. We've got a hugely positive signal from the Russell 2000, and if the market was showing any signs of weakness, then you would be seeing it in the small caps. The small caps have just broken out after some period of consolidation, so it's going back into acceleration phase, not the other way. I want to look at the reality of global growth and what it means for stocks, and of course US earnings season in full swing and going along pretty well. So just a few comments on the broader context. There is synchronized global growth really just starting, where everyone's getting in their act together at the same time. And we're seeing that Europe, China, Japan, and US are all basically moving ahead, and that's really the first time that we've had that synchronized growth. So that's the basic backdrop. Now in China, despite all the doomsayers, Chinese retail sales are going along very nicely, and industrial production also beat expectations. So if you're looking for China to fall over and derail what's going on globally, then I think you're going to be waiting a little while longer yet. The Eurozone growth is increasing, so again, it's nothing marvelous, but it's good enough, and certainly the confidence levels are rising there. We've also seen some sound growth in Japan as well, so things aren't nearly as bad in Japan as a lot of commentators would have you think. US earnings season is going along very well. It's still only early days, but at this stage, 82% are beating expectations, and that's a high number. It's normally low to mid 70s. They play this game in America where the expectations are kept fairly modest so that companies can beat them, but nevertheless, they are beating them with a higher level of occurrence than what we normally see. And overall, we're heading towards 10% earnings growth if the current trends continue, and that's pretty robust. And it certainly underpins what we're seeing in the market in terms of price rises. The success with Trump's tax agenda. Now, back in November last year when he was elected and the market took off, and a lot of people put a label on that as being the Trump trade, and they felt that if Trump wasn't able to succeed in getting his agenda through, then stocks would reverse heavily those gains. Now, Trump is certainly struggling. They've now shelved the repeal of the Obama healthcare agenda because they feel like they just can't get it through. Tax cuts aren't dead yet, but they're certainly not progressing as some people would have liked. So certainly he's not getting the traction with his agenda that many expected him to get, yet the market still keeps powering on. So it would appear that there are other factors at play there. Investor sentiment, importantly, when the market starts to get a bit too euphoric and everybody's got their money in the market, that's when you want to be worried. And all I can say is that investor sentiment remains quite somber despite the market gains. The market keeps pushing up higher, but sentiment has really not picked up that much. So again, that's a reason for the market not to be topping out at this stage. Turning to the American market, the small caps are breaking out. I think that's the big story of the week. After a year or so of consolidation, we'll take a good hard look at the Russell. And the market breadth remains at a high level. And you're just not going to get a market topping when you've got small caps breaking out with a high degree of market breadth. It's just not going to happen. So we're still in positive territory. The S&P rose 13 points on the week, and the Nasdaq and technology stocks bounced back sharply and continue to lead the way. Another very good positive for the market. So technology and the S&P 500 have shifted back to a level of overbought and are extended above the mean. So we might see a minor little retracement of the gains that we've seen in the last week or two. So let's take a look at some indices now. So we'll start first of all with the Russell. So let's pan back and take a big picture look. The last time we broke down was in January and February of 2016. So the market did appear to have changed character. We got a flattening out in the rate of increase of the indices, and we broke this critical low here. First of all, this low here was broken, and then we broke that critical low, and that occurred at the start of January. And at the time, I signaled that the market was changing character and that you should take some defensive actions. Now that correction lasted only till the end of February, and it recovered and we were back off to the races again, and you can see that we've gone up significantly from around about 1,050 points to about 1,450 at this point in time. So that's nearly a 40% gain in the Russell 2000. And it just really underscores as well that you've got to remain flexible in your thinking. Calling this a change of character and a breakdown was the correct thing to do, and taking some defensive action, because it might have been a top and it might have gone into a bear market. So you can't afford to wait too long. But as soon as the market climbed back above this level, then you needed to have the flexibility in your thinking to be prepared to get back in again promptly, and that's exactly what we did. So the market has now continued on very sharply. This was the gains that we've seen since Trump was elected in early November. So there's been a huge surge. We then have got a couple of periods of consolidation. So first of all, you could say this period here from around early December to early June. And then we got a smaller little consolidation as well, which is this little consolidation here, before we've now taken off again in the last week. And we may see this just partially pull back to test the breakout, so we might get a little bit of easiness early next week in the Russell. But look, that's a very, very positive sign for the Russell. The S&P just keeps marching on. You can see that it is a little bit extended above the 20 and the 50-day moving averages, which are the green and the blue line. It's way above the 200-day, so continuing to show a great deal of strength. So we might see a little bit of short-term weakness early next week, but you've got to say the trend is still up, and it has been up for a very long period of time. And finally, the Nasdaq. This was the last decent consolidation in the Nasdaq index, which occurred in the middle of last year, so a very broad, volatile period from the middle of 2015 through to the middle of 2016, and then it took off. It didn't really respond to that breakdown that we saw in the Russell 2000 early in 2016. So it continues to look very positive and lead the way. Now, the US dollar index, of course, is the other big story. We've had a real breakdown. We managed to break above the 100 level, but now we've come way back into that range and plummeting very sharply based on the change in position of the Fed. You'd have to say at this stage that we're highly likely for this to retest support, so a little bit more, and then we should see some sort of bounce in the US dollar. And of course, what that's done is that's really played havoc with the Australian dollar, which I'll get to in a minute. And the Australian dollar is broken out above the top of the range and got up very close to 80. I'll address that further when I go back to the slide. The Australian dollar now extremely overbought as the US dollar is oversold, and some strength in the euro is helping that plunge in the US dollar as well. So turning now to Aussie stocks, we powered on towards 80 cents, and it was really a trifecta of influences with the lower US dollar, higher iron ore prices, which I don't believe are going to prove to be sustainable, and of course the RBA comments. What were they thinking, starting to make reference to a 3.5% neutral interest rate? That just really fired up the market at a time when the RBA would want anything but a strong dollar. I just can't believe that they would have made that reference, and they were scrambling at the end of the week, backtracking on that reference to a 3.5% interest rate. So we'll see where that goes. The ASX 200 was lower by 42, so we're back to Friday blues again, where the market loses ground on Friday going into the weekend. So it just seems that no one really wants to hold too much exposure over the weekend. There is still some isolated good news stories out there, but gee, you've got to be really selective in the Australian market. Precious metals, gold rose by $26 to $12.55. That was part US dollar and part outright buying of gold itself. Silver rebounded, but as you'll see, is still really in a medium-term downtrend, so I'm not getting too excited by any of these moves. The GLD holdings plummeted down to 814, so finally we saw a response in the ETF market, and of course that's really interesting with ETFs being sold out, but gold rising. And precious metal stocks, there's really still no trend there. They're just caught in this big sideways, messy washing machine kind of action. So let's take a look at precious metals. So we'll start with silver first of all. So we've got a rebound in silver from really oversold lows, but you've got to say that we've still got a downtrend in place there in silver. So it really needs to start breaking above some of these highs here, just around 17 and around 17.75 before you could start to get anyway excited about silver. This is gold on a weekly chart, so we're still constrained by this big picture downtrend that started in 2011. And if we shift to the dailies, you can see quite a nice strong rebound, but not really being supported that much by the ETF market, by the premiums in the physical market. I haven't seen the data yet for the Commitment of Traders report, so I don't know what's been happening in the futures market, but I suspect that it will be, pretty much as it normally is. We had reached extreme levels of oversold in the futures market, which I commented on last week, and so the rebound was almost inevitable. Turning now to other commodities, copper was up a bit further. Again, that's just US dollar weakness. Crude oil slipped to 45.70. There was a bit of a drawdown in crude inventories again, but and the weaker US dollar, but it really failed to translate through in the actual oil price. And stocks are still doing pretty much what they've been doing for the last few weeks. They're showing a few gentle little signs of basing, but nothing that you could really hang your hat on at this stage. There's the spot copper chart, has edged up a bit, and there's the oil price having edged down a little bit during the week. So to wrap it up, my message is the same. Stay with the trend, keep it simple, don't try and fight it, ignore the noise, all those sort of things. The trend is up, and that's what you need to stay with. And the same comments as I've had last week about the next few months. You must allow for a mild pullback, but I wouldn't be taking any action, because the 2 to 3% pullback, which is what we've been getting, just you don't. If you start trying to sidestep 2 to 3% pullbacks, then you're going to trick yourself up. So just ignore it. Just let it happen. And in any case, if you're in the strongest sectors, then we may not see a decline there anyway. We saw a 4% decline in the Nasdaq, and that only lasted a week or two, and it shot back straight back up within a week or so of those lows. So it was only lasted about 3 weeks. So it's really something that you can just ignore. There's my contact details for non-members. Always happy to communicate, and I'll be back with you next week. Cheers.